OPEC Plus just cut oil production. Again, your portfolio is about to change. Most people have no idea why. Here's what you need to know. Oil controls inflation. Inflation controls your money. This decision ripples through everything: your savings, retirement, grocery bills. I'm showing you exactly how today. By the end of this video, you'll understand why energy stocks matter. You'll know if oil is going up or down. Most importantly, you'll know what to do about it. Stay with me. This changes your financial strategy. So here's the question: are you investing blindly or investing smart? Let's find out which one you are. On September 2023, OPEC Plus announced production cuts. Not small ones, massive ones. We're talking about 2 million barrels per day. For context, that's roughly 2% of global supply. But here's what matters to you. When supply drops, prices go up. Simple economics, right? Not quite, because oil markets are way more complex. OPEC controls about 80% of global proven reserves. That's power. Massive power. They can literally influence what you pay at the pump. They can influence inflation rates. They can influence which stocks your broker recommends. You see where this goes? OPEC decision today becomes your portfolio's reality tomorrow. Here's something most investors miss. OPEC cuts production on purpose. They're not doing this randomly, they're doing this strategically, to raise prices, to stabilize markets, to protect their own interests. But what about your interests? How does this affect your money specifically? Let's get personal, because it is personal. When oil prices spike, inflation follows. When inflation rises, your purchasing power falls. That $100 in your savings account, it's worth less next month. That's happening right now because of OPEC move. Historically, every $10 oil price increase causes roughly 0.3% inflation. You might think that's small, but compound it annually. It's not small anymore. Gas prices are your most visible sign of this problem. You see them every time you fill up. But they're just the warning light. The real damage happens in your grocery bills, utilities, transportation costs. Everything that requires shipping requires oil. Here's what people ignore: inflation affects your salary purchasing power, your rent, your kids' education. Your retirement savings lose value if inflation outpaces returns. So if your portfolio averages 6% annual returns, but inflation hits 4%, you're only gaining 2% real wealth. That's the OPEC effect hitting your long-term strategy. Now here's where this gets actionable for your investments. Energy stocks move when oil moves. Simple correlation, right? Except, it's more nuanced than that. When OPEC cuts production, oil prices typically rise. When oil prices rise, energy companies make more profit. More profit means higher stock prices, at least temporarily. So here's the trade opportunity: buy energy stocks before oil spikes. But timing that is nearly impossible for most retail investors. That's why you need a different strategy. Consider this: diversification into energy ETFs reduces your risk. Spotlight on the XLE fund tracks 47 different energy companies. You're not betting on one oil stock, you're betting on the sector. If oil prices rise 15%, XLE historically gains around 12–18%. That's real money working for you. But here's the controversial part. Should you actually be investing in oil? Many financial advisors say no, think climate change, think future energy shifts. But right now, in this economic moment, energy stocks provide inflation hedges. They protect your portfolio when currencies weaken. When your cash loses value, commodity-linked assets gain value. So yes, you might want exposure, but carefully, not recklessly. Let's talk about the scary part nobody mentions. Retirement calculators assume 2–3% inflation annually. But what if OPEC keeps cutting and inflation hits 5–6%? Your retirement timeline shifts. Your purchasing power collapses. Imagine planning for retirement on $2 million. But inflation eats half that value. Now you need $4 million instead. That's the compounding effect of ignoring commodity markets. Here's what's happening. Traditional bonds lose value when inflation rises. Your emergency fund in a savings account loses value in real terms. Your fixed income investments, they're getting crushed right now. This is why commodities matter to your portfolio construction. They're the counterweight. When stocks fall during inflation scares, commodities often rise. When bonds underperform, commodity allocations offset that. Historically, a 5-10% allocation to commodities smooths portfolio volatility. That's not speculation, that's portfolio engineering. And it all starts with understanding why OPEC moves matter. Because OPEC influences the largest commodity on Earth, and that commodity influences everything about your financial security. Okay, actionable time. Here are 3 moves based on this OPEC situation. Move 1. Audit your portfolio's inflation exposure. Ask yourself honestly, do I have commodity exposure? Oil, gold, agricultural products. Most people don't, and that's a massive blind spot. Consider allocating 5% to commodity ETFs or energy stocks. Not risky, not greedy, just strategic. Move 2. Check your fixed income allocation. Bonds look attractive at 5% yields, but if inflation runs 4-5%, you're only gaining 0.5% real returns. That's terrible. Rebalance toward inflation-protected securities. Tips are literally designed for this. They adjust as inflation changes. Move 3. Review your emergency fund location. If it's in a regular savings account earning 0.01%, you're losing to inflation every single day. Shift it to a high-yield savings account currently earning 4-5%. That's real money. Do this today, not tomorrow, today. Because OPEC decisions happen faster than most people react. And you need your portfolio positioned before, not after. Here's what separates wealthy investors from broke ones. Wealthy investors react to structural shifts like OPEC cuts immediately. Broke investors wait for it to affect them directly. Which one are you becoming right now with this knowledge? Here's what just happened in your brain. Takeaway 1. OPEC controls global oil supply and directly influences inflation, which erodes your purchasing power and retirement plans. Takeaway 2. Energy stocks and commodity allocations act as portfolio hedges against inflation, but only if you own them before prices spike. Takeaway 3. Most investors ignore this completely and regret it later, but you now have the framework to act strategically today. The OPEC move wasn't random, it was purposeful. Your response shouldn't be random either. Be purposeful, be strategic. Be ahead of 99% of people who ignore commodity markets. If this changed how you think about your portfolio, subscribe for daily personal finance insights that actually matter. Let's build real wealth together, not hope, not luck, just strategy.